Good Monday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. A cautious start for markets as investors await progress in US trade negotiations. The US Treasury Secretary says talks with Asian nations are going, quote, very well. Ukraine's President Volodymyr Zelenskiy says he's hopeful of a reliable and lasting peace. That's as North Korea confirms for the first time its troops are fighting alongside Russian soldiers. Plus, it is the biggest week for European earnings. We're going to bring you all the analysis as the region's largest companies report. European futures on the front foot after 2 weeks of gains. Can that momentum be sustained? You're still down, of course, around 7% from the February highs for European stocks. But today you're looking to build on the gains of last week, currently up 0.2%. Of course, the earnings story will be consequential, as will those trade negotiations. Here in the UK, the FTSE 100 is looking to add just 0.1%. S&P futures, though, a little bit of softness after a week of gains for US stocks. Last week, the tech companies, particularly Mag 7, coming through with gains of about 9% by the end of the week. Still not offsetting the downside, of course, year to date. And the earnings story then focuses on what is happening with some of the biggest names across Mag 7 through this week. US futures then pointing low by 0.5% on the S&P E-minis. Nasdaq 100 futures pointing low by 0.6%. Let's flip the board and look cross-asset. Treasuries relatively stable. A little bit of softness in the dollar. That's leading to a little bit of upside for the single currency in the session today. 113, close to 114 for the euro, just up 0.1%. The benchmark 10-year now at 4.24. Brent trading at $67 a barrel, up 0.4% so far on oil. Gold giving up some of its gains, though, now down about 6% since breaking through 3,500 last week. A little bit of profit taking, arguably, for the yellow metal. Maybe some of that positioning looking to some, at least, a little stretch, given the run-up we've seen year to date of about 25% for gold. Currently in the session, just down 0.6%. Asian shares kicking off the week cautiously, as we mentioned, as investors then await progress in those US trade negotiations with the region. For more, let's bring in Bloomberg MLive strategist Mark Cranfield joining us out of Singapore with the analysis. Mark, talk us through what's happening in the Asian session today. What can traders expect as well from this central bank meeting of the week, which is the BOJ, of course, in your region?
Generally an upbeat mood in Asia, particularly Japan, where there's a prospect of a takeover of Toyota Industries, which would inject a lot of money back into the equity market in Japan. So that market is outperforming most of the others. In terms of the Bank of Japan, I think you can see it in the early performance of the yen. The yen's a bit stronger, doing better than most G10 currencies so far today. And I think that's because people are warming to the idea that we're going to have a hawkish hold from the Bank of Japan this week. Nobody's expecting them to change policy this week. That's a widely shared view. But they do look as though they have a little bit of a window sometime between June and July to get on with another interest rate hike. Now, they can't ignore last week's Tokyo inflation data. It was a beat across the board, very hot inflation numbers. And clearly the Bank of Japan has been telling everybody that when the inflation numbers get to their 2% number on a continuous basis, that's what they're going to be doing to tighten interest rates further. Well, that's there. We've reached that level already. You can see the change in the language from Governor Ueda in the past couple of weeks. He clearly is not as concerned about the domestic picture politically. They've got to have elections in July. So his window may well be June. He may well go for a small increase in interest rates then. The market isn't pricing for it, but then again, it doesn't usually anyway in Japan. They have a different strategy compared to other G10 central banks. They don't really rely on traders pricing in the numbers as such. They tend to lead the market just a few days before, 7 to 10 days before a meeting, and then the Bank of Japan will nudge people in the direction they want them to go. So we can probably see the yen continue to gain traction, not to mention the fact that people, of course, are still readjusting their dollar portfolios, and most of that is being gained by the yen and the euro. You can see positioning in terms of leveraged longs and what other commercial traders are doing is very, very substantially skewed towards the yen, and there's no sign of it cooling down for the time being.
Interesting, yeah, as we see another 0.2% gain for the Japanese currency in the session today. So potentially a hawkish hold from the BOJ later this week with that decision, of course. Meanwhile, when it comes to inflation, of course, the dynamic's very different in Japan versus what's happening in China. We've been hearing from the PBOC and other officials in China in terms of the measures to support that economy. What kind of has stood out to you in terms of the latest briefing that we've had from Chinese officials, Mark?
It's another incremental move in the general supportive tone that we're seeing. Policies which started back in September when they first talked about surplus to support the Japanese market, even before they knew that Donald Trump was definitely going to be president of the United States. And we've seen gradual moves in that direction. PBOC has reiterated that they're going to maintain a loose monetary policy. But maybe the most significant thing is to do with the currency. Once again, they are telling us that they will keep a strong and stable yuan, and they've managed it very, very carefully, even in the sight of all these disruptions we've seen in US markets and global markets over the past couple of months. The yuan has stayed in a pretty narrow range, and it's obviously part of their plan as well is to try and get more investment into the country, whether it's through the bond market or through the equity market. And clearly you need a stable currency to be able to achieve that as well. So the central bank is fully behind that. And they're showing more ways in which they're trying to attract people to use the yuan. So it's something we can expect to see over the months ahead, where the usage of the yuan in global flows, in global trade, is probably going to increase. It's not going to be any threat to the reserve currency of the US dollar, but clearly China would like to see a lot more usage of the yuan, and that's something they reiterated today.
OK, Bloomberg AM Live strategist Mark Cranfield, thank you for breaking down what we've been hearing, of course, from Chinese officials in the latest briefing, and looking ahead to the BOJ, Japan as well, in focus for us this week. Let's get to the trade negotiations then, because President Trump says he is looking to strike a deal with China and de-escalate the trade war with Beijing.
They want to make a deal, obviously. Right now, they're not doing business with us. You know, people talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us, you know, not because of them, because of me. Because at 145%, you can't do business. But something's going to happen that's going to be positive.
OK, let's bring in Bloomberg's Balash Pence then for the latest in terms of how these negotiations are unfolding. Some 17 nations, a lot of focus on Asia, a lot of focus, of course, on China as well. Investors watching for any move in terms of the needle on some of these discussions. What is the latest on these trade negotiations?
Right. As we heard over the weekend, there are negotiations with 17 plus one countries, the plus one being China. And it seems like some of them are going faster than others. South Korea, Japan, India seem to be progressing much faster. We heard that there may be some sort of an announcement on South Korea as early as this week. But typically, trade negotiations don't take weeks. They take months, sometimes years. And when it comes to China, we haven't heard a lot, to be honest, and we don't even really know what it is that Trump might be looking for in terms of a concession from China. And when we look at the other side of the ledger, when we look at the communications from Beijing, we heard over the weekend, on Friday and today as well, that they are planning for contingencies. They're planning for strengthening their economy for the event of a more protracted trade war. So it doesn't look like there's a lot of progress being made on that front.
OK, meanwhile, on the corporate level, in terms of adjusting to these tariffs, fast fashion chain then, Shein, previously a Chinese company now based and headquartered in Singapore with that global footprint, hiking US prices ahead of the tariffs. What do we know? To what extent is this potentially a canary in the coal mine in terms of higher prices for the US?
It certainly does look like the first of many such steps yet to come. We heard from Shein that they raised prices on a range of products, from kitchenware to beauty products, kitchen towels being some of the most affected products. But what it really tells us is that the changes in U.S. trade policy are really affecting prices now. When it comes to Shein, it's not just the tariffs, it's also the elimination of an exemption for small value products that's gone into place. But what we can expect is more of this to come. Main Street will be affected, and the effects are just now starting to trickle through. Some economists are already warning of a potential supply shock coming to the U.S. as soon as next month. And that may put more pressure on the U.S. administration to progress more quickly on those talks.
OK, excellent update. Thank you for joining us. Bloomberg's Balash Pence joining us out of Hong Kong when it comes to the trade negotiations and the adjustments that some of these companies are already making. We did hear from the US Treasury Secretary Scott Bessent as well, defending the Trump administration's economic policies. In an interview with ABC's This Week, he said the aim is to ensure the US bond market remains the safest and healthiest in the world.
We are setting the fundamentals for a strong dollar, a strong economy, strong stock market, and for investors to know that the U.S. government bond market is the safest and soundest in the world.
OK, and the calm hasn't always been there, of course, across the Treasury market and the bond market of the US since Trump took over for his second term. But there's a bit of calm today. Valerie Teitel, let's bring you in at this point, of course, our markets reporter. It is a big week for markets once again on the earnings front, on the data front. Out of the US, non-farm payrolls on Friday, the BOJ out of Asia. What are you watching for?
Tom, that's right. It's a big week for U.S. economic data. On Tuesday, we get consumer confidence. Wednesday, the first reading of first quarter GDP for the U.S. We also get some manufacturing data, and then the big one on Friday, the non-farm payrolls. We also have, as you mentioned, the big tech reporting. We get 4 of the Mag 7s reporting later this week. Honestly, Tom, what I'm watching out for is if we do get soft economic data, do treasuries begin to trade like a safe haven asset? Let's flip on and check how that 30-year real yield has been trading this month, because frankly, Tom, treasuries in the month of April did not trade like a safe haven asset. We saw treasury yields rising alongside the equity market declining, and those measures of 30-year real yield, that's if you strip out inflation from the 30-year real, actually hit their highest since 2008. And this is a sign that investors are demanding more term premium. They're demanding more yield for holding a longer term assets, and in a way almost pricing in the fact that we are going to have the long end trading like a risky asset for a time to come. Is this the new world order for treasuries, that we do see this rising term premium across the curve on sour economic data? That's what I'm going to have my eye on this week. I also want to note, Tom, the Bloomberg Dollar Spot Index, it did have its first gain last week, the first weekly gain in the month of April. So things do seem to be stabilizing a bit when it comes to the deterioration of the U.S. dollar.
OK, stability for now, at least for the greenback, and we look ahead to see whether or not that term premium is a more sustained story. Bloomberg's Valerie Teitel on what to watch for the markets this week. Thank you. Here's what else to be thinking about as well. When it comes to Europe, the focus is going to be largely on the bank earnings. Some really big names reporting with their details out throughout this week. And, of course, we'll have the analysis through that. For example, you have UBS reporting on Wednesday alongside Barclays and Santander, SocGen as well over in France. Before that, Tuesday, you get earnings through from HSBC. Relatively new leadership, of course, ahead of that bank, so we'll get some details there. Any commentary, of course, from any of these lenders in terms of the potential economic impact of tariffs, supply chains, and how they see that factoring into rates and the broader economy will be of interest. And then, of course, on Thursday and Friday, you get the UK focus, NatWest, Lloyds, Standard Chartered, of course, with that Asia pivot, and what is happening in terms of the Asia region and emerging markets will be an interesting gauge. On Wednesday, on the macroeconomic feature and front, we're going to get European CPI, so European inflation. It seems to be getting in line, of course, with the ECB's target. We've been hearing that from ECB officials. Then you get GDP prints out of the US. And on Friday, it is the big one in terms of the labour market of the US, the US jobs report, that detail dropping and expected to see a bit of a slowdown in hiring, but unemployment expected to remain at around 4.2%. Coming up to geopolitics, President Trump rebukes Vladimir Putin after a spontaneous huddle with Volodymyr Zelensky at the Pope's funeral. You can see that remarkable photo there in terms of that 15-minute conversation. We have the latest next on Ukraine, Russia, and President Trump's views on how that story is evolving. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. A man has been charged with 8 counts of murder in Vancouver after a car rammed into a crowd on Saturday night. 11 people were killed and more than 24 injured in the attack in the Canadian city. Police say they are confident the incident was not an act of terrorism and that they anticipate further charges against the 30-year-old suspect. Staying with Canada, voters there head to the polls today after the snap election called by Prime Minister Mark Carney last month. The Conservative Party, led by Pierre Poilievre, was leading polls by about 20 points when Justin Trudeau announced his resignation in January. But since then, the race has tightened under a new Liberal leader and economic anxiety over US President Donald Trump's tariff war.
Prime Minister Mark Carney, former governor of the Bank of Canada and the Bank of England, leads the Liberal Party into the election after taking office last month.
My government will put into action our plan to build a stronger economy, to create new trading relationships with reliable trading partners.
Carney's rival is Pierre Poilievre, the leader of the Conservative Party. A few months ago, Poilievre was riding high. Polls showed him heading for a landslide victory, potentially securing a two-thirds majority in the House of Commons. But things have changed. Since Carney entered the race, the political landscape in Canada has shifted. Poilievre's lead has evaporated, and both the New Democratic Party and Bloc Québécois have lost ground. If the Liberals don't win a majority, however, they'd need support from the NDP or Bloc Québécois. Complicating matters, U.S. President Donald Trump's aggressive trade policies, particularly new tariffs on Canada, are dominating discourse about the election. On top of that, Trump's suggestions Canada could become the 51st state in the U.S. have drawn more attention than domestic issues, and those comments have changed the political climate. Both Carney and Poilievre have taken a strong stance against Trump's provocative rhetoric and policies.
The president is betraying America's closest friend and attacking our economy, proving once again that Canada must end its era of overdependence and weakness.
For Canadians, this election is a referendum on their economic future. The outcome could determine how the country addresses these challenges and how it positions itself on the world stage.
Okay, so from the Canadian election to Ukraine now, where that country's president says he's hopeful for a, quote, reliable and lasting peace. That's after he met with President Trump ahead of the funeral of Pope Francis on Saturday.
They have a tough road ahead, okay? And we had a good meeting. It was a nice meeting. It was a beautiful meeting. I'll tell you, it's the nicest office I've ever seen. It was a beautiful, beautiful scene. But he was very, look, he wants to do something good for his country. He thinks he's doing a good job, and he's working hard. We'll see what happens.
Let's bring in Bloomberg's Russia economy and government editor Greg Sullivan joining me now for the latest. So President Trump talking about that meeting that he had for about 15 minutes, of course, at and just ahead of the Pope's funeral with President Zelensky. Does that meeting, both sides talking positively after that conversation, does it get us any closer at all to finding the parameters of a peace deal?
Well, it certainly does seem that on the one hand, President Zelensky did sound an optimistic note, and of course we heard from Secretary of State Marco Rubio saying that this was the start of a very critical week in those negotiations. On the other hand, we did hear from President Trump after that talk, acknowledging that potentially Russia does not want peace. He did seem to reference a missile strike on Ukraine, which, of course, the talks followed one of the deadliest airstrikes of the year from Russia on Ukraine. And he did seem to say that potentially Putin doesn't want peace and was maybe dragging out the process. We heard President Trump actually threatened potentially more banking and secondary sanctions. Of course, Russia is very sanctioned already, but it does represent a change in tone from President Trump, who up until now, his administration has put forward proposals that critics have said were very favorable towards Russia. And of course, Europe and Ukraine had worried that in the rush to a peace deal, their own security might be sacrificed. So this definitely represents a change of tone on that regard.
Yeah, a marked and notable, as you say, change in tone from the US president. And we'll see to what extent he continues that line of pressure now on Russia, to some extent, at least rhetorically. Meanwhile, North Korea, Greg, confirming for the first time that it has deployed troops to support Russia's war on Ukraine. What are the implications of something that we have long known, of course, but now North Korea coming out and saying, yes, we have troops deployed?
Well, it's very interesting. As you said, this has long been known that they have deployed troops and they've been supporting Russia with military ordnance. Of course, last year, the two countries signed a defense pact to support each other in areas of defense. So this is confirmation of those deepening ties between the two countries. Ties, of course, that worry Washington, and even Beijing is eyeing warily. And of course, China has been a diplomatic and economic supporter of Russia since the beginning of the war. The other thing to note here is that as Russia is claiming to have kicked out Ukrainian troops from the Kursk region, it's also a loss of a potential bargaining chip for Ukraine as negotiations heat up. Ukraine, of course, wanted to use that toehold in Russia's territory as at the bargaining chip to potentially strengthen their hand. And of course, if they have been expelled, that would mark a loss for them of a strategic chip.
Yeah, we're still waiting confirmation from Ukraine that they have indeed lost all of that territory. That is still disputed by Ukrainian officials. Bloomberg's Russia economy and government editor with the latest update. Greg Sullivan, always excellent. Thank you in terms of how that story is evolving. Coming up, we're going to switch focus because as AI drives demand for power-hungry data centres, we're going to take a look at the impact on the global energy mix. That is next. This is Bloomberg. To artificial intelligence now, AI promising, of course, to transform the global economy, expected to place huge demands on energy, with seeing that already in places. The team at Bloomberg NEF has just published its new energy outlook for this year. Its head of energy economics, Matthias Kimmel, joins me now from Milan to break down what they have been seeing. So, Matthias, we know, obviously, that AI is going to be a huge demand pull on energy. How much energy are these data centres, these AI data centres, likely to consume?
Well, data center demand is going to grow in the future because of artificial intelligence. Our estimate is that around 2035, 4.5% of global electricity demand goes into data centers, up from 1.4% today. And today, data centers are used for cloud storage, but also increasingly AI. By 2050, that share is growing to 9%, or almost a doubling compared to 2035.
And how does that demand then, the electricity demand of AI, compare to other demand drivers?
It's significant, but it's not the largest source of growth. If you compare it to electric vehicles, for example, they consume around 30% more electricity over the next 10 years compared to data centers. Plus, in developing countries, for example, you have more industrialization. You have households adding air conditioners and also other household appliances. Those tend to outweigh the demand for data centers in these economies.
What does this mean for the transition to cleaner energy? To what extent is this a roadblock towards that transition?
Yeah, it's not going to make it easier. Especially because data centers are being developed and built today and in the coming years. And the challenge for governments is to decarbonize their electricity generation. A lot of the capacity they were building today, the electric capacity, solar, wind, is already at capacity. So it's going to be an additional challenge once data center demand comes in. Our estimate is that over the next 10 years, 2/3 of the electricity demand that new data centers need comes actually from fossil fuels, and the other third renewables. And the reason is that fossil fuel power plants are existing today. They can run longer and they can run more, and they have a little bit of an advantage over solar and wind.
Okay. Bloomberg NEF's head of energy economics, thank you for breaking down the story for us, Matthias Kimmel, on the AI energy demand. And the new energy outlook will be a major focus of Bloomberg NEF's two-day summit in New York, starting tomorrow. Plenty of speakers. You can get more information on Bloomberg.com. Coming up, this is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. A cautious start for markets as investors await progress on US trade negotiations. The US Treasury Secretary says talks with Asian nations are going, quote, very well. Ukraine's President Volodymyr Zelensky says he is hopeful of a reliable and lasting peace as North Korea confirms for the first time its troops are fighting alongside Russian soldiers. Plus, it is the biggest week for European earnings. We're going to bring you all the analysis as the region's largest companies reports. Check in on the markets then. 2 straight weeks of gains for European stocks, still down around 7% since their February highs. Today, looking to push a little higher then, looking to build on the gains that we saw come through last week, pointing up by 0.1% on the European stocks 50 futures. Here in the UK, FTSE 100 futures currently looking to add just 5 points. S&P futures stateside, though, in negative territory, down 0.6%. Similar picture for the Nasdaq 100 futures after gains that came through last week for US stocks. Let's flip the board and have a look cross asset then. Is it a big week in terms of the macro data? We get non-farm payrolls out of the US on Friday. Before that, we get US GDP. We get the BOJ decision out of Japan, and then a major week, of course, for earnings, both in the US and here in Europe. The benchmark US 10-year currently yielding 4.24. A little bit more calm across the treasury markets, at least for now. The euro getting a bit of a lift on dollar softness, just up 0.1% on euro dollar at 113. Brent at $67 a barrel, gaining 0.5%. And gold down 0.7%, now off about 6% since breaking through 3,500 last week. A little bit of profit taking coming through, it seems, for some investors in the yellow metal. Let's get a broader picture in terms of the analysis across these markets. Bringing Naomi Fink right now, Chief Global Strategist at Nikko Asset Management. Naomi, good morning. Thank you for joining us. We have seen, it seems, a little bit more calm across the markets in the last week or so. Do you expect that relative calm to be sustained? What are the factors, what are the catalysts that you're watching for these markets in the days and weeks ahead?
First of all, it's always a pleasure. And secondly, on the markets, well, I think we did see a move into a higher vol regime that I think may have even predated the current U.S. administration. We saw a spike in vol last summer, and then we've seen a return in vol after we started the new U.S. administration. So I don't think that's changed. I don't think we've gone back to the low vol regime, but even higher vol regimes are characterized by highs and lows. And since we haven't seen any big news come out over the past 24 hours, then perhaps the markets are taking a bit of a break. I don't doubt, however, that if we do see any new surprise, then markets will most likely react. I don't think we've seen the absolute end to market volatility. That said, if we look a little bit longer term, do we have reason to hope that we might have a better outcome of the ongoing trade negotiations than we feared on 2nd of April? I think we have reason to think that this is a possibility. I don't think we're in definites yet. We can't talk in terms of definites, but I think we have reason to think there could be a slightly better outcome than we initially feared.
So what does that slightly better outcome look like, Naomi, and where are markets in pricing that in at this point?
So I think the slightly better outcome is comparative to a very bad outcome indeed. I think 2nd of April, many were thinking that there would be an all-out trade war, retaliation, escalation, and there still are quite a lot of tensions, especially between the U.S. and China. But if we do get a dial back on the tariffs announced on 2nd April, and there have already been pauses, there have been deferrals, etc. But if those are made permanent, I think that will be a better result than initially feared. And if we actually see greater resolution between the U.S. and China, because I think that's a big focal point in these trade tensions, then it will be even better still. But again, that's not a given. And even on a bilateral basis, we haven't seen any definite come out. So while there's reason to hope, then there's still some risk that we will see a poor outcome on when it comes to global trade.
And how are you thinking about risk premium then, pricing in across US assets? Is that a longer-term theme, higher risk premium for US assets on some of this volatility, on some of the challenges around the Treasury market, the dollar, and the question marks about debt sustainability in the US? How are you thinking about that as a longer-term trend?
Well, I think there is a real risk that we do see a longer trend of higher risk premia for U.S. assets. And that has partly to do with the indebtedness of the U.S. And also there's a big question of whether the U.S. is truly giving up its position of seigniorage, basically, seigniorage of the U.S. dollar in global markets. As we know, the U.S. dollar and U.S. assets, especially treasuries, are an outsized proportion of global reserves. And one of the main reasons why that's the case is because the U.S. dollar is the currency of last reserve. But the U.S., if the U.S. is willingly giving up that position and saying, well, don't think of us as the consumer of last resort either, then it seems very rational to reduce that proportion of U.S. assets. And that involves reducing treasuries, and that involves higher yields. Note, that doesn't necessarily mean that we go to zero or even below half. It's just that we have a very, very high representation of U.S. dollars. So I think the U.S. dollar can afford to go lower if we even see a slight decrease, and yields likely to stay higher on trend.
Okay, further higher yields, further dollar softness potentially. Naomi, before we let you go, where are you and the team at Nikko finding opportunities at this point?
So first of all, I think there are opportunities in surplus currencies or surplus countries and assets of surplus countries and their currencies that may have the wherewithal to offer consumers some stimulus and thereby buffer their growth from external shocks. So Japan is one example. It's possible that we get a surprise out of China at some point too. In the Asia-Pacific region, there are many surplus economies that may be able to afford stimulating domestic demand. And so a lot of these, at least the stock markets, have reflected a lot of bearish sentiment. So it's possible that we might have seen some relative overshoot, especially if we compare it to the performance of U.S. bourses. So diversification is probably merited. Also, within U.S. stocks, I think there's been a lot of homogenization, especially when we've seen the regimes of ever lower rates and ever lower tax rates. So if we don't have any further to go on that regime, I don't think opportunity is dead in the U.S. But I think what we'll be looking at is firms that provide future value that are able to keep their margins intact by truly innovating. So a move toward greater active.
Yeah. Naomi, thank you very much indeed, giving us some clarity amid the continued tariff uncertainty. Naomi Fink, Chief Global Strategist at Nikko Asset Management. Let's get to the earnings story right now. The big week, the biggest week, in fact, for European earnings by market value is about to get underway, with some of the continent's largest firms reporting, particularly in banking and autos. Charlie Wells is here with a preview. But first, some M&A news, Charlie. This crossed about an hour ago or so. Mediobanca offering to buy Banca Generali. What do we know about the deal? What it tells us as well about consolidation within the European banking space.
Yeah, Tom, so this is something of a Monday morning surprise in Italian banking, which has been pretty dramatic over the past couple of weeks, I would have to say. So what we do know, at least as of now, as of a statement from Mediobanca, is that Mediobanca has offered to buy Banca Generali for 6.3 billion euro. Now, Banca Generali is the wealth manager, the private banker controlled by Assicurazioni Generali, so Italy's largest insurer. And what this would do for Mediobanca, this would help them diversify, right? It would help them diversify into that wealth management space that a lot of major global banks have been trying to do. But it could also be a defensive play, right? Because there has been so much consolidation in Europe, so much attempted consolidation throughout Italy. And we need to remember so many players here, but Mediobanca itself faces a takeover bid from Banca Monte dei Paschi. So many players, so many banks, and this could be a defensive posture to try to kind of expand and diversify and heat that off. But oh, sorry.
No, I think you framed it really nice. It's a complicated picture, isn't it? And these moves are being made by these different players as consolidation, particularly in the Italian banking sector, does seem to heat up.
And they're trying to get shareholder approval in June, mid-June, but that's a long way from now.
OK, so we watch for that as well. Charlie Wells on that detail. You're looking ahead to the banking earnings story as well. What are you going to be focused on in terms of what could stand out for the numbers out of European lenders?
Huge week for these large banks. And I think, we're kind of looking back, but also looking forward. That first quarter could be really positive on the trading front, right? We had all of that volatility. We've got some of the banks in Europe that have large equities trading units. I'm thinking about UBS. But there's also, questions about how these executives are navigating the trade war. I think there's going to be a lot of questions on kind of forward guidance here. An interesting bank to look at as well would be Deutsche Bank, reporting on Tuesday. They had so much upward momentum early on in this year on the back of that German fiscal spend. Their share price kind of careened down on concerns about the trade war, but they've picked up momentum. Let's see how their executives kind of square the circle there when they report.
With the auto sector, is it just all about tariffs? In terms of the direct impact, it's hard to think of another sector that feels the pain and the squeeze as directly as the auto sector.
It really is. They're subject to those 25% tariffs, and some of the biggest names across Europe, VW, Stellantis, are going to be reporting this week. And, I think those two companies in particular are exposed in a lot of ways, not just because they import a lot of parts, they export a lot to the United States as well, but because they sell to that kind of mid-level consumer who's coming under pressure. We're looking at car sales in Europe expected to flatline this year, and so that could pose another risk for these companies who are already subject to a lot of these tariff headwinds.
Charlie Wells, thank you very much indeed. It's setting us up really nicely in terms of what to think about when it comes to the earnings with the banking space and autos in Europe in focus this week. Now, some other stories making the news this Monday. Airbus reaching a final agreement to take over some assets from Spirit Aerosystems, clearing the way then for the struggling US aerospace supplier to be acquired by Boeing. Airbus says it will receive $439 million to take on loss-making facilities that produce parts for the European plane maker. The Airbus deal is a key part of a complex three-way transaction that reunites Boeing with Spirit, an operation that it spun off in 2005. And China's Huawei is reportedly preparing to test a new AI processor that it hopes can replace some products made by Nvidia. According to the Wall Street Journal, Huawei has approached some Chinese tech companies about testing the new chip. The report says development is still at an early stage, with firms slated to receive the first batch of samples next month. And voter discontent with President Donald Trump's economic policies is sinking his popularity as he approaches the symbolic 100-day mark of his second term. A flurry of recent polls say voters perceive Trump to be falling short on his core campaign promise to strengthen the economy. A CNN poll showed just 39% of Americans approve of how the US president has steered the economy. Coming up, as drones become increasingly indispensable for defence and security, we talk to a UK firm on the front line, literally, of making them safer and more agile. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. President Trump is piling pressure on Ukraine and Russia, of course, to sign a deal to end more than 3 years of war. Late last week, Kyiv accused Moscow of launching nearly 150 attacks on the front line, with drones being behind many of the assaults. The British drone maker Evolve Dynamics has been making and testing some of its machines on the front lines in Ukraine. Very pleased to say the company's CEO, Tom Redman, joins me in the studio right now. Tom, good morning. You brought in a drone for us as well, so we'll get a shot for that for our audience of what that looks like. Talk to us about, briefly, top line, what Evolve does and what drones like this are able to provide for those servicemen and women on the front line in Ukraine.
Morning, Tom. Firstly, thanks very much for having us on the show. So here at Evolve Dynamics, we are a British developer and designer and manufacturer of small ISR drones. ISR is intelligence, surveillance, reconnaissance. So drones have been critical on the front line in Ukraine. We've had systems in there for about 3 or 4 years now. We've been developing drones for about 10 years. And the ability to have the real-time information on the battlefield, so the distribution and movement of the enemy almost on a real-time basis has been transformational. But it's also been a huge challenge having systems in the field. Some of the learnings that we've taken is you need to be able to operate in the most complex environments. And when I say complex, I mean radio, the communication is becoming increasingly challenging to operate due to jamming by the Russians. The GPS denial, even things like environmental factors like wind and rain. So you need to be able to operate in tough environments. Autonomy is becoming a huge part of what we do here. So we've been on a huge push since we've been in Ukraine to miniaturize our products. And what you're looking at is one of our latest products, the Fox. This is less than 250 grams. It's designed to be deployed from any soldier. It takes about 90 seconds to get it out of your pouch and into the sky and able to do its job.
You talk about the need to be agile and to innovate, and the timeframes around this are pretty incredible. I just wonder to what extent the primes, so the big major contractors, are able to have the agility that's needed as we look at that increased defence spend. How much of that is going to be a challenge going forward?
I think that's the big challenge for the MOD. You're right, the pace of innovation is completely transformed by Ukraine. We're not looking at months and years to develop new iterations of the product. We work on a weekly basis. So the product you're looking at now, we're already on to the next sprint. It's going to take us about 2 months to develop a brand new product. It will have folding arms, increased autonomy. So working with primes is absolutely plays a part in the defence ecosystem. But I think there's a challenge for the UK MOD and the British forces to adapt to the agility that we're seeing in the battlefield and increase the pace of innovation.
And are you seeing the impact of that increased defence spend? If you're not seeing it now, when do you expect that to come through?
I think we're seeing signs of increased engagement. I think there's a recognition that the pace of innovation needs to increase.
But on funding, is it going to startups like yours, the innovative smaller firms, or is it all being directed again at the primes?
So the funding and the increase in the spend to 2.5% of GDP by 2027, I think that's coming. I think there's a stated desire that UK SMEs are going to be part of that. We have yet to see a major acquisition of small drones like this by the British Army, for example. I think it's coming, and I think that we're well placed to be innovative and be a partner to the UK MOD.
So, Tom, we have the Fox on the table here. How reliant is that on Chinese supply chains?
Not at all. So there
are no Chinese components in this?
None of the critical components are Chinese. Nothing that has data going through it, communications going through it. This is a sovereign designed, and we have a supply chain which is British, is the US and EU. That's taken us a number of years to build a scalable supply chain that we can rely on. It's hugely important.
We've had a number of different drone companies come in and onto the show. There's something like 200 drone companies operating in Ukraine alone. Is there a need for consolidation? Is there a concern that there's a lot of companies trying to catch this wave?
Yeah.
Do you see consolidation?
There probably will be a place for it, but diversity of technology on the front line is actually also a big asset, because there are certain things like radios or types of technology in EW warfare which can be jammed or can be the adversary finds a way to counter that technology. So if you put all your eggs in one basket and go with one solution or one manufacturer, that's not actually a great solution. So the diversity, I think, is a good thing.
What's the ambition for the business longer term? Do you move out of UAVs into land-based drones, into water-based drones, sea-based drones? What is the ambition, and how do you turn? Are you profitable at this point?
We are profitable. We are operating on a very agile basis. So we design and develop, and when we do our assembly, we assemble with UK-based assembly partners. So we don't have a huge number of employees just sat around. We're focused on development. Our ambition, we're very focused on this space, which is in the man-deployable intelligence gathering drone space. Our ambition, really, we think that the UK can play a huge part on the global platform in terms of leading in innovation. That's been led by China with DJI drones for a number of years, and we think there's a huge opportunity for us to catch up and leapfrog that technology and to bring down that price point so it's affordable for users.
Okay.
We don't want users to see this as a huge outlay and a big asset. This needs to be attritable, and if you lose a system, then you just get another one out of the bag. Okay,
leapfrogging DJI, that is ambitious. Tom Redman, thank you very much. Thank you very much indeed for joining us in the studio. Evolve Dynamics Interim CEO. Now some other stories making the news this Monday. EY Item Club says the UK economy, meanwhile, grow half as quickly as previously expected in 2026 as Donald Trump's sweeping tariffs hit business investment. The influential forecaster has warned that shrinking exports and more subdued household spending will hit the strong pickup in growth previously projected. EY Item Club, which uses the UK Treasury's economic model for its forecasts, downgraded its growth prediction for this year from 1% to 0.8%. DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo shares at £1.80 a piece. DoorDash has two-thirds of the restaurant delivery market in the US, and a deal would help it expand into the UK and elsewhere in Europe. And a 5-1 rout of Tottenham Hotspur has seen Liverpool become the champions of the English Premier League. The record-equalling 20th title matches the achievement of Liverpool's great rival, of course, Manchester United. The team secured the win 15 points ahead of London side Arsenal. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Yes, it is all about the Mag 7 tech stocks, at least when it comes to the US this week on the earnings front. Here in Europe, of course, you have a focus on banks and autos, but stateside, you have the likes, of course, of Meta and Microsoft reporting on Wednesday, Amazon and Apple on Thursday. Nvidia is a month from today, but of course consequential in terms of AI chips. There has been a bit of a rebound. There was last week in terms of the Mag 7 stocks, up about 9% last week, still down about 15% from their record highs. The analysts are still expecting pretty decent numbers. Does that need to be revised lower? Alphabet came through with a beat. We'll see what happens, of course, for these companies. Consequential in terms of the earnings story amid the tariff and trade uncertainty. Let's flip the board and have a look in terms of the broad picture and just the size and scale of this week when it comes to the earnings story. $20 trillion of market cap reporting. Worth noting, of course, those Mag 7 stocks make up about 20% of the weighting of the S&P 500. Let's flip the board and have a look at the macro data. The big one this week is the non-farm payrolls dropping, of course, on Friday. Focus on unemployment, focus on the wage data as well. Hourly wages expected to tick up in terms of the estimates, 3.9%. Top line, you're expecting the jobs number to soften a little from the previous months, about 130,000. Unemployment expected to remain at 4.2%. The labour market and any cracks in that we know is going to be consequential and important for Fed officials who have suggested maybe they're open to cutting a little bit earlier than some had previously expected. And before we let you go, let's flip the board and have a look at what's happening in gold, because there's a little bit of profit taking coming through for the yellow metal. And when it comes to futures positioning from hedge funds, particularly in the US, at around the lowest level for about 14 months. So has it run its course in terms of the upside for gold? A lot of that will be down to the uncertainty, of course, and any clarity we get through from the Trump administration. Still up about 25% year to date, but down about 6% since breaking through 3,500 last week. So continue to watch what happens in terms of the gold story as that evolves. The opening trade is up next. Stay with us. This is Bloomberg.